Joining us this morning to discuss, former BridgeWater chief investment strategist Rebecca Patterson's here, Post 9 RP. Good to have you back.
Hey, good to be here.
So we got starts today, and permits 4 straight months down. We haven't done that since '08. Is the Treasury Secretary right about this stuff?
Look, if the Fed cuts rates, all else equal, that supports growth, it puts liquidity in the market, that might help the consumer to buy a home. But you've got a couple other challenges here that I think the Secretary could have added to his list. So you have input costs. The tariffs are not necessarily helping that. You have labor costs. Immigration is not helping that right now. Insurance premiums. Insurance has skyrocketed for housing. That's something that could be looked at. But the main thing I'd focus on is that mortgage rates are set on the 10-year yield, not the Fed funds. And what we saw last year when the Fed was cutting, what we saw from the Bank of England earlier this month, is even when we got rate cuts, that spurred expectations for more growth and inflation, which pushed up the 10-year yield. So it hurts housing. So I think it's a lot more complicated than just the Fed cutting equals a housing boom.
Right. Mortgage rates bottomed last fall just as the Fed began to cut, as you say.
Correct.
Why do we take then this notion as gospel that if the Fed cuts, mortgages will be cheaper?
I don't. I don't think any of us do.
Well, it usually happens. It didn't happen last year, but generally the 10-year yield, or certainly the 2-year, follows the Fed funds rate.
Often, yes. Yeah. And I do think part of what we're dealing with now is just a different regime in that inflation being higher and stickier changes how the 10-year is reacting to policy changes, right? So when we were in a world for 20 years-ish with extremely low inflation, the only thing we were watching was jobs and the Fed. So if the Fed's cutting, it helps jobs and all is good, right? And if the Fed is cutting because we have a recession, people are going into bonds for diversification for safety. If we're in a more inflationary regime, where do you want to keep your money to be safe? Equities are actually a better inflation hedge than bonds, all else equal. So bonds being the diversifier is more of a question than it has been for the last 20 years, and bonds reacting in an inflationary environment, in a supply-demand challenged environment, they're not going to behave the same way to Fed cuts that we've seen in the last 20 years when inflation was low. We're just in a different place.
But the controversial thing there is that you are preparing for an inflationary environment where we might not be going into an inflationary environment. I get that the tariffs are coming through, but it's coming at a time where we're also starting to see pressure on the labor market. We're also starting to see companies deploy AI at this unprecedented rate, and all of that pushes away from inflation.
So I agree with you on the labor market piece of it. We are starting to see more signs of a softening labor market. I think we will see a lot more as we go into the end of the year and next year. If you look at the Conference Board CEO survey that just came out, 34% are expecting job cuts in the next 12 months. That was larger than those expecting a higher. First time that's happened since COVID. So we're going to see an acceleration of jobs cuts as companies try to control costs. So that part I agree. If the labor market softens enough, the Fed cutting may pull down long-term yields. And it might pull down inflation as well. The part I'm a little less sure about is that AI productivity, disinflationary Goldilocks boom. When does it happen? To what degree does it happen? I think it's probably out there, but even when you talk to the hyperscaler CEOs, they don't know. They don't know the timing. Right now, I think we're really in the build-out phase. Companies are spending money to integrate AI and train their staffs. I think we're still a little ways away from seeing this disinflationary Goldilocks.
So you think that the cuts that are taking place are more as a result of all the spending that's going on as well, and just to offset some of that, as opposed to anything from the efficiencies already being brought to bear from AI in the enterprise?
That's what I'm hearing from CFOs that I'm speaking with, and I know you all speak with tons too, but they're saying we're being pressured by our CEOs, our shareholders, our boards to invest in AI and reap the efficiencies. That's great, but it costs money up front. And if you're at a time where the economy is uncertain and you want to control costs, if I'm spending on AI infrastructure, I have to find an offset somewhere else. Part of that, I think, is going to come through headcount, either hiring fewer people or actually trimming headcount a bit. And I think that's ahead of us. I think it's just begun.
Right. And that's with a lot of older Americans retiring at a huge rate every month. Rebecca, we'll talk more about maybe some of the hyperscalers later, but thanks for coming in. Good to see you.